In this short video, we're going to dive into how Fitch organizes its analysis of debt issued by feeder funds. Feeder funds are entities which issue debt and equity and use the proceeds to invest in an equity position in another fund, known as the main fund. The main fund, in turn, can invest in a multitude of assets depending on the manager's strategy. Repayment of the debt issued by the feeder fund depends substantially on the performance of the assets held by the main fund. The rating analysis of feeder fund debt is anchored by the quantitative rating indication, or QRI. This is overlaid by a qualitative assessment, or QA, which may result in a downward notching of the QRI. The final rating is guided by the QRI, adjusted by the QA, and may be subject to additional rating constraints. Finally, unless the assigned ratings are point in time, Fitch monitors the performance of the transaction during its life. The QRI is the quantitative anchor of the analysis and is assigned on a scale of AAA to CCC. It overlays expected portfolio composition and asset quality, the Fitch expected portfolio, with structural features of the transaction. Sector-specific criteria, based on asset type, inform our view on underlying asset quality. The QRI for a class of debt is generally equivalent to the most stressful rating case, in which the cash flow analysis indicates full repayment of interest and principal according to the terms and conditions of the obligation. The qualitative assessment, or QA, captures incremental risk relative to QRI. It is a notching adjustment to the QRI, which can be either neutral or downward. The overall QA adjustment is a committee decision based on indicative notching for the three QA factors: asset quality and main fund leverage, fund and manager, and structure. Each factor is assessed qualitatively, considering various sub-factors. Fitch may give more weight to individual sub-factors based on their relevance to the rated transaction. We may view certain characteristics of a feeder fund debt transaction to be incompatible with certain rating levels, or with any rating at all. Such additional rating constraints are highlighted in the criteria document and cover diverse areas such as data quality, third-party dependency, and investment guidelines and strategy, among others. We expect most feeder fund debt ratings to be in the A category or lower. This is due to ramp-up risk and flexible legal structure, common in many feeder fund debt transactions. Furthermore, leverage at the main fund may constrain the rating of the feeder fund debt. As an equity holder in the main fund, the feeder fund is structurally subordinate to any main fund leverage. In this example, we pull together the three analytical pillars of the criteria to illustrate how feeder fund debt ratings are determined. In this hypothetical example, Fitch was asked to rate two classes of notes issued by a feeder fund. The quantitative analysis of the Fitch expected portfolio and the debt structure yielded a quantitative rating indication of A- for the Class A notes and BB for the Class B notes. The committee agreed on a qualitative adjustment of -1 notch. Additionally, the committee determined that the ratings are constrained at A+. The final ratings for the two classes of notes are therefore BBB+ and BB-, given the combination of the QRI and the QA. The additional rating constraint has no impact in this case, as the QRI is already below A+.